Hi, it's Nash from Alpha Phi. Please smash that like, hit the subscribe so you don't miss anything that I release in the future. We're going to dive into the Mass Mutual 10-pay product in a little more detail than the last video. We'll talk about the 10-pay and how, when you take a loan, that it does not impact the growth of your policy. That's because you can actually select whether you want a variable policy loan interest rate or a fixed loan interest rate. If you choose the variable option, you can actually make sure that it's non-direct recognition, which means the company does not realize or have any direct recognition treatment to your dividends when you take policy loans. Therefore, you receive the same dividend as if you hadn't touched the cash value in the first place. And so, once you take the loan and after you pay it back and restore it, your policy looks as if you hadn't touched it in the first place. So really cool. We're going to dive in, but first let's cover some basics of the Mass Mutual 10-pay. So this is a very high performing cash value product. It is a limited pay product. Normally the number in the product title will kind of give you an indication of how long you can make those premium payments for. Since it's a 10-pay, it's a limited paying period product of 10 years. And so normally when you have a shorter paying period, those come with lower death benefits because the company's expecting that you're going to pay, or it's the product design that you're going to pay those premiums for a less amount of time, giving you a lower death benefit amount. It also has a low guaranteed rate of 2%. That means above the 2%, it's going to have a higher dividend surplus. The company declares the same dividend for all products, but depending on where that guaranteed rate is, the surplus will be different. So this is a very heavy dividend weighted product, and that's why it's known for its accumulation, or its cash value accumulation, and being a high net IRR product. Remember, companies always declare gross dividends, but what you really want to look at is the net growth year over year. Because when a company declares a 6% dividend, for example, like Mass has in 2023, that's before insurance expenses, mortality charges like paying death benefits, those sorts of claims. And so you really want to look at what is my cash value growing by on a year-over-year basis. Whether you like dollar values or percentage points, and I like to look at both because I am truly an insurance nerd. So net IRR of 5%, so quite high after those insurance expenses and mortality charges. So we've got a high cash value design here, a 10-90 split, meaning $10,000 going to base premium, $90,000 going to PUA, specifically their AILR rider, additional life insurance rider, and then that sums up to a $100,000 total out of pocket for a maximum of 10 years. And so we cut it off after 10 years. And we're going to look at a loan of $100,000 taken out at year 12 for 5 years, so paying it back in years 17. We're also going to show the interest payment being paid out of pocket just so we can keep the numbers straight. And so the key question is there any impact to my growth on my policy? So let's dive in. Okay, here I've got the growth scenario on the left and the loan scenario on the right. So I've just put these numbers into Excel, and so they're easier to read and look at here. So the target payment here, $100,000 for 10 years. Now with Mass 10-pay specifically, you don't have that LISR rider attached. Otherwise, it would drag down the performance. It's just pure AILR. Both of those are PUA riders. However, the difference is very important. LISR adds quite a bit of flexibility, where AILR is more like you have to treat it like an annual bill. If you don't make those payments, you could lose the ability to contribute that amount, or you might have to go back through medical underwriting. So this is a drawback of the 10-pay, but good to be aware of. If you're not concerned about having the amount, the 10-pay product is a really, really strong option for you to consider with Mass. So $100,000 for 10 years, $1 million out of pocket total. $100,000 in, $88,816 in cash value, and a death benefit of 1.34. So 89% coming back to cash value in year one, almost 90%. That's very strong. Same on the right, exact same performance, The liquidity hit for any whole life policy is going to be the first and second years are the most painful. And then after that, you start to overcome those expenses in fees if it's designed for max cash value and maximum flexibility. And so you start seeing the accumulation thereafter that is more than you're putting into the policy. Year 2, another 100,000 in. Slight negative here on the IRR, still coming and having some of those expenses and fees. So it's about 4,000 less than you've put in that you have in cash value. You can do that quick math here. 88,000 plus 100,000, 184. So still about 4,000 in fees we've been unable to overcome. But by year 3, 100,000 in, 184 grows to 288. So it's growing by almost 4,000 on its own. So it's overcome those expenses and fees, and it's adding more back into your cash value. And this is where the magic really starts to happen. By year 4, 400,000 total out of pocket, 397 in cash value. And by year 5, you've cleanly broken even. So it's a break even between years 4 and 5 here. And then you can see the growth just continues and continues on. Same on the right, so 511, 488. And these numbers are identical until you take your loan out here. Actually, it's in year 11. So, loan out here in year 11 of $100,000. $100,000 for 5 years, and then we pay it back. So what's going on here when we take that loan? You'll see that the death benefit is being collateralized by that policy loan. So on the growth scenario where we haven't taken a loan is almost $100,000 more than the policy loan scenario. Okay, and when we pay that back in year 17 here, let's look at the cash value and the death benefit side by side on the growth scenario versus the loan scenario. So 1.646621, 1.646621, 2.485653, 2.485653. Identical values, and it continues to be and perform identically. We can do a spot check out here. Age 77, identical numbers. So with a non-direct recognition company, when you take a loan and you pay it back in full, the policy is going to continue as if you hadn't touched the money in the first place. Now, I actually did a double check as well, just making sure in each year the cash value and the death benefit, we want to see zeros here. This means they're identical. There's no difference. Now, during the loan years, not only is the policy collateralized by the $100,000 loan, but also by the policy loan interest, because that interest is billed and due on the following policy anniversary date, and it's going to reserve that interest up front, so it adds to your loan balance. And if you pay it off, it doesn't compound and add to your loan balance for the next year. You're just charged the interest carrying over year over year because it's due. It's annual simple interest. So that's why you see that interest being added each year. Now, where did we get that loan rate? Currently, it's an adjustable loan rate of 5.07%. So I just took this from the software so that we can tie that off right there. Now, the adjustable loan rate. Policy loan rates are reset on each policy anniversary and remain in effect for the entire policy year. Okay, so it's not like it's fluctuating all over the place all the time. Mass Mutual will increase the policy loan rates only if the new rate would be at least 50 basis points greater than the previous loan rate. So it has to be 0.5% higher for you to receive an increase. Mass Mutual must decrease the policy loan rate if the new rate would be at least 50 basis points less than the previous loan rate. Okay, that doesn't sound great. It's above, if it increases, you have that protection, but also on the decrease, that wouldn't be great. However, Mass Mutual's current practice is to set a lower loan rate even if the new rate is less than 50 basis points reduction from the previous loan rate. So they kind of contradict themselves here. I think, maybe they're just reserving the right to change that practice, but actually it won't increase. In summary, it won't increase unless it's gone up by 50 basis points. Then it would jump up. If it's 0.49% increased on the index, then it wouldn't actually increase your loan rate. But if it goes down by 0.1%, not that 50 basis points reduction, the current practice is to give you that reduction. The loan rate is subject to any applicable contract minimums and statutory caps. So the minimum adjustable loan rate for MassMutual Whole Life Product Series is equal to the policy guaranteed cash value rate plus 1%. So if you recall on the PowerPoint we started off with, the cash value guaranteed rate is 2%. So plus 1% is a 3% floor. So really, really good. Now, let's look at this. This is tied to the Moody's corporate yield average. So how do you track that? Well, you can just type it into Bing or Google. So I went here and I clicked on the Y charts thing and I just zoomed it out. So this is the 5-year. So going back to 2018 down to now. So what happened in 2022? Well, rates, because the Fed hiking cycle started and it really took off. So we were back here at 2%. Now we're at about 4.53. So you know, the rate was set this year when we were back here kind of at the peak. That's why it's 5.07. But that's not that bad compared to third-party lines of credit right now. They have a spread on there in addition to following some of the indexes. So those rates are up in the 7.5% right now. So we're, you know, that snapshot was taken at 5.07% and it's starting to come down. So you don't even have to hit that 50 basis point reduction. You're actually going to start seeing a reduction in your policy loan rates if you have a MassMutual policy, especially if you've had it out here. Now, if you snapped it over here, you know, at 3%, it's a 3% floor, right? So 3%, you might see it increase, but it's not going to go up to such high values as the third-party loan rate. But look at this. Over a long period of time, you know, we've been largely below or at around the 3% rate. So this, especially if you expect interest rates to come down in the future, might be a really, really solid option. Now, let's look at the products here. So, base policy insurance, this is the growth scenario. $10,000 going to base premium, the rest going to Ailer and the renewable term rider. Now, this is just pure growth, okay? And what I did was take this and put it into the Excel file, but I also took the loan scenario and put that into the Excel file. Okay, so we were looking at those numbers, but let's sanity check. Okay. Okay, so what I did was take snapshots of those PDFs and put them side by side so that I can prove to you that all the values in the Excel file I put over here. So we've got the gross scenario on the left without the loan, so you see 100,000 going in for 10 years. Then we see the loan scenario, 100,000 for 10 years, and then that loan here in year 12 paid back in year 17. Now, I've highlighted the year after the loan payback, and so what we've got here is we're looking at this cash value here. Now, this is the gross scenario on the left and the loan payback scenario on the right. Exact same number. Now, what's also interesting is that while we have the loan out, this is the dividend column. The annual dividend is what I'm highlighting now, annual dividend. So in the exact same years, with that loan out, the dividend does not change. This is why it's referred to as a non-direct recognition treatment. There is no recognition that there's a policy loan out, and therefore there's no impact to the dividend. So, really, really interesting and great option to be aware of, especially if you're active and want to take policy loans, reinvest in something like cash flow and real estate so you can grow your wealth in two places at once. This is a really great option, but it's mainly for people who are not concerned with being able to make that payment every single year, not just the 10% going to base, but also the 90% going to PUAs, or in this case specifically Ailer, because you lose a little bit of that flexibility. If you haven't heard about that, please look at the video linked at the end of this one, and that'll give you a lot more information into the Euler rules and what you got to know about if you're interested in something like this. All right, I hope this was helpful. Drop a comment, leave a like, subscribe, and I'll talk to you soon. Thank you. If you enjoyed this video, please like and subscribe. Also, you can learn more at alphacrusaders.com at the link at the end of this video.